All right, we are live. Welcome everyone, and welcome Matt from the Equilibrium. How are you, brother?
I'm doing okay. How are you?
Doing phenomenal. For those that don't know or aren't familiar with who you are, I want to first give a little heads up to everyone. Normally, our guests are experienced within the 5 year range within the market, but you have an extensive history with the market. That's why this episode is going to be so exciting. Please give us a little introduction on your background revolving around the financial market.
Sure. It's been a strange journey, right? It wasn't like I woke up one day and went in this direction and the rest was history. Definitely have worked a full career in the over the years that I've been following the market and slowly transitioned into being a trader full time. I've been trading for over 20 years. When I first started getting into trading, email was just becoming a thing, so it was a whole different universe, and really completely self-taught. And we didn't, people of my generation didn't have the benefit of the YouTube videos and the mentors and everything that are out there. So you just do a lot of trial by fire, and that's definitely how I learned how to trade. Made all the mistakes I could probably think of. Probably couldn't even name them all again because I made them all, and just learned the hard way, right? And over time, developed discipline. And what a giant leap forward social media is, and YouTube, and all of the people you can draw from now. So you're not trading literally by yourself. A lot of us, that started off a long time ago, didn't even have people to talk to because not everybody was involved in this the way that they are now with the advent of Robinhood and the ease of trading on your phone. There weren't that many people that were into it. So a long story short, I got into this initially via technical analysis. I was an architect in a previous life. I still actually didn't even have hair then, but I was an architect previously. And so I've always been visual. So I got into the market through technical analysis and looking at charts. And that's what really drew me in. And over time, just learned a trading system. Again, going through a million different varieties of strategies, and honing in on things that worked for me. And here we are today. It's stuck with me. It's got to be a passion that you have. Otherwise, it can quickly kick you out of the market. But the passion was there, so stuck with it. And here we are 20 years later, still going.
Right on, right on. So, speaking of technical analysis, you just mentioned there's a million different ways to go about looking at it. Through all of these years, I'm sure you have discovered or trialed with many different forms of trading. Which is the one that made ignited a click inside that you're still using consistently to this day?
In terms of technical analysis, or
Yeah.
just so I think the biggest click, people have asked me like, what was my aha moment? And honestly, it's really simple. It was basic position sizing was my aha moment. And I base that on technical levels. So I'm not the kind of person that says, all right, I'm going to put in a 10% stop or an 8% stop. And that's just the generic stop. I base it on, previous day candles or a moving average or some technical level that makes sense. But position sizing to that risk, to that stop level, and realizing that I can take trades over and over, and you're going to have winners and losers, and you just keep going. And as long as you don't blow up your account, you can have longevity. That was honestly my aha moment, as kind of uh, rudimentary as that seems. Prior to that, in the beginning, I had just been taking like obscene risk, and expecting everything to work out and hoping that things would work out. And that's the way you blow up accounts. So I think my main aha moment where I went from pure, unadulterated speculation and slash gambling to actually trading was just figuring out a reasonable position sizing strategy and going from there.
Now, speaking of your position sizing strategy, I recall sometimes you tweet about having a 50% loss ratio because your stops are so tight. And I'm sure that revolves around your position sizing. Do you want to elaborate a little bit more regarding that?
Sure. So I have it's like 50 to 55% over the years. So you're flipping a coin. You're getting stopped out a lot, right? So that's the idea. And you can be, if you do the simple math, I'm sure you've seen all the charts about, what percentage, what basically batting average you have to have, and then what, size wins you have to be profitable. Obviously, the higher your win rate, the less You have less mileage you have to get out of your wins to be profitable. And if your win rate is down around 25%, you got to make those winners really pay, or you're going to have a really hard time being profitable, obviously. So, and the range is anywhere in between. But what I do is my stops are generally tight. I mean, it depends on the name because there's obviously hugely volatile names that you may have wider stops on. But in general, I'd say my stops are the 2.5 to 5% range. And this is a whole different ballgame with options, which I know is obviously your wheelhouse. For options with me, my stop is 0, but the sizing is the same. And what I'll do is I'll size a position based on the distance of my entry to my stop, and that's what will give me my position size based on the total account risk I'm willing to take. So for me, it's roughly 0.5% per trade is generally my sweet spot. It used to be more than that. When I was younger, when growing an account, I would take 1% to 2% trades. I personally don't recommend taking more than 2% of your account on any single trade. But now it's around 0.5%. So 50 bips is generally what I say is my standard trade size. And so if I'm missing 50% of the time, I may have 10 in a row that are losses because it happens just statistically. And what that will do is give me a drawdown of 5%, no bigger than that. So, the way I do this is I guard against drawdowns. It certainly limits the upside a bit, but it guards against drawdowns, and that's where I've found a sweet spot for me over the years.
Okay, okay. And since your win rate is about 50 to 55%, how do you go about ensuring that the winners are, regarding options, are consistently providing your portfolio with growth and overcoming the losses that the other side of the options are providing?
Well, specifically in terms of options, I look at it the same way with equity. So I'm sure I trade options differently than you do. I'm assuming I do, but I'm guessing I do because you day trade and I do things a bit differently, and I'm happy to elaborate on that.
Mm-hmm.
But what I'm looking for is an average return from a winner, defining it by a risk multiple. So if my loss is one risk unit. Let's call it 1 times risk, right? I need my winners to be more than 1 times risk,
Mm-hmm.
and on average, that's definitely what I achieve. So usually, I'm in the 2 to 2.5 range. So if your batting average is over is over 50%, and your winners are 2 times and a little bit higher than 2 times your losses, you're going to make money over time. And of course, sometimes you have outsized wins, and those are great. So the old saying, we're happy to take big wins, small wins and small losses, but never big losses. That's the way it goes. And over time, the pattern of your trading ends up being that you average out, the early for me, I average out around 2 times the size of my risk for my wins, but occasionally you will get these outliers that really tweak your returns. And that can come from options as well, obviously, because the leverage is there.
Right, right. You mentioned being open to share or possibly screen share one of your plays. Do you mind just going over maybe a win or a win that occurred this week or either of the weeks and demonstrate how you approached your entries, identifying that this position you're in is going to be a winner and allowing it to truly fulfill and cash in the majority of the move.
So yeah, I didn't prepare one actually, but let's pick one out. Let me flip through here. Um, let's see. I'll pick one that I'm still in. That's just a recent trade here. So let me actually. Would you be able to screen share and I'll show you something?
Yeah, sure. Let me
Because I'm
go
just on my
ahead and
laptop and I've got a weird setup going on here. If you
no
could
problem.
put that up.
Let me go ahead and open up my broker and get things running. All right, good to go.
I'm not seeing your screen yet.
Oh, let me put that open for you. Share screen. Let's do Weeble share. Boom.
All right, perfect. Thank you very much. So let's do Upstart.
All right.
Okay. If you go on the daily, and just you probably don't trade daily charts ever at all, do you?
No, I do, but Upstart is just not a name I have been too familiar or too comfortable trading just yet.
Gotcha. So let's zoom in a little bit so we can see some of those candles a little more clearly. All right. So the green inside day, that's a few days back. Um,
Let's
if you go to
find
go
it.
to the left a little bit, get the inside day there, the green one. To the right a little more. Sorry about this. It's in the 212
Oh, right
range,
here,
right
right
there.
here.
That one. So this is the type of thing I'm always looking for, right? I'm always looking for range contraction, because that leads to range expansion, obviously, right? So always on my radar, inside days in names that are leaders. So to take a big step back, I'm always looking for relative strength. I'm looking for names that are in the strongest sectors, the strongest industries, and the strongest names within those industries. And I'm always looking to buy high, sell higher. This a lot of people will call this a different names. This play, you can see the earnings gap there on huge volume. Some people will call it a peg play, post earnings gap, or PED, post earnings announcement drift. But this is just the concept where a gap higher on earnings or a gap lower, it works to the short side as well on huge volume. That stock tends to drift in the direction of that gap over weeks, days, weeks, and months. So that's what this is. And how I play this, some people will take the immediate gap and try to get a gap and go. So back on that earnings day, some people will take that trade. What I do is wait for it to consolidate. So this price gapped up. I don't know what day that is, like August 12th, right there, right? Gapped up, kept going. You could have taken a gap and go. I don't take those types of trades, but some people do. So I waited for it to consolidate. And that consolidation for me that caught my eye is that inside candle right there that you've got your cursor on. So the way I set that up was I'm going to go long on a move above the high of the previous day's candle and put my stop. Let's see, where did I put my stop? I put my stop at 212, so close to the low of that green candle. Um, so that's my risk right there. That's the difference. That's what I was talking about. And this was with equity, not calls. I don't even know that there's a call chain that's um, like viable on Upstart. Honestly, there probably is. But so this is the trade that was set up. I took it around. Um, let's see, two. I took it around 208, and my stop was my original stop here is at one. No, yeah, 196. So the bottom of that green candle. So that's the whole setup right there. So you're seeing I've got close stops, right? So that's an inside day trade. I take trades like that frequently, but this name has a lot going for it. It's a growth name. The whole Can Slim crew is checking it out. There's a lot of people involved in this name. Really good relative strength. Has the tailwind of have a post earnings announcement drift play behind it. All that. So wait for the consolidation and take it on the next day. So took that at one times risk. If you just graphically, you don't have to put this in there, but you can visualize, graphically one times risk. That's where I take my first partial. Then roughly around two times risk is where I took the second partial. Now the third one I still have on, so I'm still in this trade as it moves up higher, and it is around 3.7 times. No, excuse me. I've got a problem with this monitor here. That's why this isn't working out so well. It's around 2.7 times risk right now. So I've taken two partials already, letting the third partial run. And what I do is I will either wait for it to break below. Sometimes I'll put a stop below the previous day's low, which I'm not doing here because I'm just letting this run. And if I'm going to let it run, what I'll do is take off the last partial on a close below the 9-day SMA. So basically that's a general anatomy of how I'll trade. I'll try to find range contraction, get a good risk reward setup here. The whole idea is while we don't know what our reward is going to be, you want to reasonably be able to project based on a technical level or a breakout, fib extensions or a measured move, et cetera, that your risk to reward is roughly 3-1. That's the general, rule that I want to go by. I will take a tight stop and then take partials at one times risk, two times risk, and if things are going well, let the third run. That's my general recipe.
Okay. And just a little question that can potentially help out some viewers. So you, once you're taking your position, you see the position is working, and you take off your first partial, you're comfortable enough and you know your technical analysis to allow your position to fulfill to the next partial and your final position. Now, some people, they'll see this downtrend inside day. Of course, the break of the inside day, we're going to have a movement to the upside. Now, people will go ahead and catch that first chunk of the move, but go ahead and just put the chart in the back burner once they see a little bit of consolidation or a little bit of drawback at when those contracts, say if they held, would either go back into break even or go slightly back in the red. What allows you to be able to have conviction to hold on longer? Is it your expiration? Is it the fact that it's not breaking any of your predetermined stop losses? Now, mind you, if it broke stop loss, let's say, around here, those options have decayed way further as compared to if the stop loss was triggered, on your second day or so. What's your key for allowing it to trigger that next leg up while still being in it?
So yeah, I mean, this was a stock trade. This was not an option trade, and my option trading is definitely different, right? Because there's that huge variable of time that's entered the equation, and my option trades will definitely be quicker. And for instance, if I was in options here, I probably would have been out the majority of the position on the day one breakout, because I trade weekly options unless I'm taking a position trade, in which case I'll buy leaps.
Mm-hmm.
And position trading is a whole different ballgame. I focus on swing trading because that's what takes up most of my time, and that's how I feel I can compound my account. But I certainly have long-term accounts with position trading going on. So my option trading, maybe I should take a step back and just talk about how I view options. But my option trades would certainly be quicker than this, because I normally don't buy options that are a month out, 2 months out. I'm looking for weekly. So Mondays and Tuesdays, I'm buying that. Fridays, weeklies. Wednesday, Thursday, Fridays, I'll buy the next week's Friday expiry options, and that's how I'm trading. I'm looking for really quick moves. So I generally would not even be involved in a trade for that amount of time, if I'm taking options. And I use options, not, I won't say sparingly, but for certain reasons.
Gotcha.
Um, and I guess what I'll tell you is, for instance, in 2020, I was playing options trades a lot, right? Because the market was firing on all cylinders. So that's when I wanted to absolutely hit the gas. There was almost no rotation. I was strictly playing option trades for leverage, right? So to get quick moves, everything that was set up to break out was breaking out in 2020. That was like a year that was a gift to all of us, right? But that's not normally the circumstances. So what I do normally, when a market is choppy or just a regular market as opposed to 2020, I will use options to short, because I don't like to have the gap up risk. I don't like to have that risk when you're actually shorting stock at all. So I'll buy puts to short. I will use options when the underlying is extremely volatile and susceptible to gaps, something like SLV, the silver ETF. Um, Tough to find a day that doesn't gap up or down. So I'll use it for things like that. I will use it for big mega caps sometimes, like Apple, where for me to get a tight stop, I'm over allocating my capital because the stop is so tight, that I end up putting too high of a percentage of my capital into the trade to take the risk that I want to take. So then I will use options because it makes more sense. And those are the main reasons. And then when the market is firing on all cylinders, I will definitely use options to juice my returns, because that's when you can take advantage of the leverage, in my opinion. But for a choppy market, 2021, I've definitely cut back on options trading, and have done a lot more stock trading. But in those certain parameters, the ones I just mentioned, that's when I will take option trades.
Gotcha. Now you're mentioning stepping back once you see the market is in a consolidation zone for options. Uh, some people will have a little bit of a mindset blockade even when other traders are telling them you have to adapt to the market environment. What are some tips for newer traders to escape that mindset that they need to trade every single day, or that they can't or they don't have to adjust their play style for the given day?
Right. Yeah, I think there's a lot of seat time that is involved in figuring that out, but I think in the there's a couple of major influences that happen when you're a newer trader, right? One is you're getting this barrage of social media, right? Where tons of rocket emojis and people pounding their chest, right? So this is something that can really get into your head um, if you're not curating your own stream a lot, and you have to be very careful of falling into the FOMO of social media, and thinking that everybody out there is in the big mover that day, and they're in those big movers every day, and you're the only one that's missing out, because that's not reality. I don't I don't think that Twitter I don't think that most new traders are following people that are really giving them a good insight into what trading really is. Honestly, I think a lot of new traders follow some accounts that are full of hubris, and make it seem as if you wake up each morning and you just pull money out of the market like a magic trick. And that's just not reality, right? So I think you have to first understand that you have to align yourself with people that are trading in the real world. And that takes curation on your part to find people that are doing that. If you never see anybody post a loss, you're following the wrong person, right? If the person is just bragging constantly, you're following the wrong people. So you have to get out of that mindset of thinking that there is some secret out there, and that there are a club of people that have found the secret sauce, and just wake up every day and this is easy, and bam, there's my $1 million, like, because that's not reality, right? So that's what I think the very beginning trader who um, may have very little experience may be seeing on social media, and that's one of the bad influences that comes with social media. So you have to find the people that are giving you a real indication of what trading really is. One of the other things I do with people that have more experience is I will say, and I've got people that I talk with who really have a problem with overtrading. And overtrading is something that I definitely have a problem with as well. It's like a lifelong affliction. It is what it is. There's sort of no way to make it disappear entirely. But one of the just simple exercises I try to do with people is say, just don't trade tomorrow. Just don't trade at all. Just tell yourself, I don't care if the market is roaring. I don't care if everybody on your stream is making tons of money. You're just not going to place a trade, and you're going to see that the world didn't end, that you didn't miss anything, that there's going to be another setup coming, and that you just have to get it into your brain that you don't have to be in every trade. You don't have to catch every name. You don't have to catch every move. You don't have to catch every rotation. And I think that really honestly only comes with experience. But the new trader is tempted to believe that every single day is a day where you're supposed to make a ton of money. And it's just not reality, as we know.
Right, completely agree. Now, while we're still on the subject of uh, things that new traders need to realize, throughout your journey, over your 20-year journey with the market, I'm sure you've learned lots of emotional lessons as well as technical analysis lessons. What would you say is three lessons that have essentially been scarred into your brain that are now the backbone of your trading philosophy?
So it's definitely starts with risk management. Like that's the whole game, right? I even and people don't want to believe that, I suppose, initially, but anybody that's a profitable trader and has been around long enough understands that's the entire game. I had somebody comment the other day, actually, that say, you have such a positive Twitter feed. How does focusing on risk management deal with that? Is like, how do you reconcile that with your positivity? Isn't that the definition of being negative, focusing on risk management? So there's a lot of confusion around this. Risk management is like your seatbelt, and you have to be in charge of what level of risk you're taking, what your drawdown can be at any time, because you're going to have moments where the market goes against you, and maybe all of your positions go to zero or are stopped out. When I trade options, my stop is zero, so that's the way I look at it. So you have to guard against a time when maybe 6 or 7 of your positions go to zero, and not allow yourself to be exposed to too much risk, so that you can come back and trade tomorrow. So that's number one, is always focusing on the downside. I focus on the downside more than the upside. And that's what made this person comment, isn't that pessimistic? And the reality is no, because the optimism comes in because I know I'm going to survive. I know I'm going to make it to the next day, and I'm going to keep going. I'm going to keep going forward, and I'm not leaving myself exposed. Right. So that's number one. Um, in terms of three lessons learned, I think that's the biggest because we've all blown up accounts, right? So I've blown up accounts as well, and that honestly happened to me when I first got exposed to options, like getting handed a hand grenade, didn't know how to use them properly, blew up an account, and you rebuild. The second one is to not think of it as uh, anything more than executing on your preparation. So you don't. I suppose that means achieving clarity by letting the decisions come from charts. These are things that's one of the main things that I've learned. So one of the big problems I used to have is over analysis, analysis paralysis. Setting up like seeing a trade, projecting what's going to happen and just not taking it because this is wrong. There's not enough volume there. It's the third Tuesday of the month, whatever, whatever issue. And I think one of the biggest things that I learned through struggling like that with over analysis and analysis paralysis was that all you can do is prepare and execute. That is really all you can do. So at a certain point, you just have to take your mind out of the equation and execute on what you've prepared. So being prepared is a cornerstone in getting rid of the micromanagement, the second guessing, the over analysis, and all of that. I'm trying to think of a third major lesson. There are plenty of lessons, obviously. I guess one simple one is that I will never average down ever in a million years, which means it's a corollary to I will never cancel my stops. So never ever ever cancel my stops, and that's a big one because people will fall into that very basic trap of, oh, it's going to turn around, it's going to go higher if I just give it another day, and you end up with a quick 30% loss in your account that is devastating and tough to come back from. So that's another one that leaves a big scar when you cancel your stop, or you let's say you're trading options and you cancel your stop and then it goes to zero, right? And you weren't planning your risk around it going to zero. So that's a huge one, is never, never, ever canceling stops. That's probably right up there with, I mean, it goes hand in hand with risk management. So those two are right on the same level in terms of priority.
Got it. So it seems like your philosophy is you can't control the upside, but you can definitely control the downside.
100%. Right. So, and like one of the things I say is, which do you want to focus on? Do you want to sit there and focus on the upside and let the downside be out of your control? Cause that's going to take you out of the game quickly. Right. So you need to be 100% in control of your downside. And if you're taking smart setups, you're a trader that's got some experience, the upside is going to come, but you have to always guard against the downside.
Gotcha. And now I got your website pulled up here. Do you want to give the people a little background of what you have to offer? I know you have a service. You have your Twitter, you have your website. Please take the floor away and let the people know what you have to offer.
Sure, thank you. So I started this service almost a year ago, actually. I don't really promote it much. I've got a core group of people on there that I really enjoy working with, and the whole idea, and I think the whole idea of any service, and I know you do this as well, is not to spoon feed people. People, especially new traders, should not be blindly following. It's not going to work for you. You may get some winners and you may feel good about it, but you are learning almost nothing. So, and I know, that you don't run your service this way either. And this is my goal, is to teach people a process, and to show people how I'm making decisions and why I'm making decisions. And that's the whole idea. And one of the things people need to understand is that you're going to take losses. You're going to have, you're going to have to monitor your risk. You're going to get used to market dynamics. You're going to, like, obviously I want to teach people how to find reasonable setups, how to deal with different market dynamics, because those things are critical. But once you have a basic foundation in those kinds of things, the rest of it is psychology, and perseverance, honestly. So those are the things I'm trying to show people by being transparent about what I'm doing. I think that's a great way to learn, right? And then these people can ask questions. So I have people. I love when people ask questions, and I'm not talking about questions like, "What do you think of XYZ stock?" Right? Like this open-ended question. I want people to ask questions like, what will you do if this happens in the market? Or what do you do, on a big drawdown? I love to engage with people in real questions that you have to think about, so that we can help each other, improve and improve on the process. And I love it when people ask me about my process. What's your reasoning for that? Why did you do that? That's what I consider real learning to be. So that's what my site is entirely about. I have a private Twitter feed, like most services do, where I'm trading and showing exactly what I'm doing, where I'm entering, where I'm taking partials. But more importantly, I'm really just throwing out there commentary about what I'm seeing, what I see setting up, how I'm viewing, the market dynamics currently, how I'm preparing for a possible change in market dynamics, things like that. So that's what I like to pride myself on, is trying to teach people to stick to a process, find a process, and then the goal is that these people don't become lifetime members and stick around forever. The goal is that they become confident traders, and then trade on their own. That's the whole idea, right? Maybe they stick around because they like my commentary and ideas, but not because they're reliant on me to trade the market. So that's the idea. That's the way I look at any service. And I honestly think, um, there's a whole camp of people out there that really deride services and really, have sort of an angst about them, right? That they think it's a nefarious activity. And I don't feel like anything could be further than the truth. Like, of course, there are some scams out there, like there are in any business, right? But you can go out there and should go out there and test run multiple services, get your feet wet, see how somebody's thinking, see how somebody's viewing the market, take their process, internalize it, and tweak it, and go from one to the other, and learn a lot from different people. I would encourage people to think of a service as a one-time monthly fee, unless it sticks. And you're getting a window into somebody's process is what it is. So that's what I'm trying to provide, is what I'm saying, because I know there are services out there where it's straight up, here's an alert, I'm long, jump in, don't ask me questions, and that's not what I'm trying to do.
Gotcha. And I love what you said about taking someone's play style and tweaking it a little. A lot of new traders don't realize that the most successful trading style that they're going to have successful is a trading style that revolves around their individual needs, and don't understand that essentially every trading style works. It's just what works consistently for you. So very well said.
Right. And in fact, the way you were asking me before, when we were talking about Upstart, and you were saying, how would you look at this? How would you have the conviction to keep going here? It's just exemplary of how everybody's got a different personality. So a different style is going to resonate with them. For some people, they want to take gains immediately, right? Some people are just simply anxious and nervous, and maybe you're not going to overcome that and be a position trader that has to have tremendous conviction and take 40% drawdowns. So you have to figure out what works with your personality. And there is no one right way to do it. So you have to figure out what resonates with your skill set. And I think a lot of people don't get that. They think that there's a recipe, right? So I just have to follow this recipe. But the truth is, you have to figure out what your skill set is, what your personality is, and what fits with that the best.
Beautiful, beautiful. Very well said. Well, thank you so much, Matt, for taking your time and sharing your views on the market with us. This was honestly a treat. Like I told you off air, you are an unknown mentor to me. Before I found your Twitter, my emotional trading viewpoint was just a mess overall, and consistency was my biggest problem. So please, the least anyone could do is go ahead and follow your Twitter. Take your tweets and your charts that you're posting and find all the value in them. So again, thank you, Matt, for
I
your time.
appreciate that. I mean, I love your content as well, and I really appreciate the compliments, and I'm glad it resonated with you, and honored to be part of your journey the way that you're part of mine.
I appreciate that, brother. All right, I'm going to go ahead and cut the recording off. And thank you, everyone, for tuning in.